You've heard it a million times, right? Big companies making these even bigger promises about sustainability. But what happens when things don't go according to plan? Who's actually responsible? Well, today, we're going to unpack a new set of rules. Think of it as an accountability blueprint that finally helps us get a straight answer.
I mean, it's the million-dollar question, isn't it? A company puts out this glossy report promising to slash its carbon footprint or totally clean up its supply chain. It all sounds amazing. But when those deadlines get missed, who takes the heat? So often, it's almost impossible to figure out who is really in charge of making it happen.
And that's exactly where this new framework, the IFRS S1 governance disclosures, comes into play. It's designed to just cut through all that corporate jargon. You can think of yourself as an accountability detective, and this is your new favorite tool. It basically forces companies to stop talking in vague terms and start naming names and detailing actual responsibilities.
Okay, so before we dive deeper, let's get on the same page about what we even mean by governance. In this case, it's pretty simple. It's the company's internal rulebook. It lays out who gets to decide things, who has to act on those decisions, and, most importantly, who is ultimately accountable for handling all the sustainability-related risks and, of course, the opportunities. So let's start at the very top of the food chain, right? The board of directors. This is where the buck is supposed to stop. Here's a really easy way to think about it. The board is like the teacher in a classroom. Now, they aren't down in the weeds doing the project themselves, but they are the ones who set the assignment. That's the big picture sustainability strategy. They set the deadline, those are the targets, and they create the grading rubric, which is how they're going to measure whether the company passed or failed.
Now, here's where it gets really interesting. Under IFRS S1, companies can't just say, oh yeah, the board oversees this. No way. They have to point to the specific committee or even a specific person. They have to spell out their exact duties, explain how they keep tabs on progress, and this one is absolutely crucial. They have to show how hitting these sustainability targets is tied to executive pay. Because, money talks.
Okay, so if the board is the teacher handing out the assignment, who's the one actually pulling the all-nighter to get the homework done? That brings us to the role of management. Let's stick with our classroom analogy. If the board's the teacher, management is the student group leader. They take that big assignment from the board and they break it down into actual tasks. They delegate, they check the day-to-day work, and they're the ones on the ground making sure that project gets turned in on time. And just like with the board, the rules here are super specific. A company has to name the management role or the team in charge, say the chief sustainability officer. They have to detail the controls and procedures they're using to manage all these risks and show how this sustainability work is actually woven into other parts of the business, like finance, operations, or internal audit. It proves this isn't just some side hustle.
So let's just put it side by side to make it crystal clear. The board is all about the big picture. They set the strategy, the what, and the why, and they oversee progress from 30,000 feet. Management, on the other hand, is on the ground. They are the how and the when, executing the strategy and managing all those risks day in and day out.
All right, enough with the theory. It all sounds good on paper, right? But what does this actually look like in the real world? Let's get down to brass tacks with a few industry examples. So let's take the auto industry. You might see a disclosure that says the board's innovation committee is formally in charge of overseeing the massive, and I mean massive, shift to electric vehicles. And crucially, hitting fuel economy targets is directly baked into the CEO's compensation. Then, at the management level, you'd have a VP of sustainability who actually leads the emissions reporting, working hand in glove with R&D and finance. See how it all connects? Or how about the apparel industry, where the supply chain is, well, everything? In this case, maybe the board's audit committee is tasked with reviewing supplier labor compliance every single quarter. Then, down in the management ranks, an ESG manager is responsible for making sure that chemical safety controls are literally built into the procurement process itself. It's a really similar story in agriculture. You might find the board's sustainability committee oversees the big goals, like reducing pesticide use, and surprise, surprise, progress is tied directly to executive bonuses. Meanwhile, a chief sustainability officer is managing the nitty-gritty, like tracking water use and making sure those reports are part of regular supply chain audits.
And one last example, biotech. Now, this is a big one for risk, right? The stakes are incredibly high. Here, you could have the board's ethics committee with ultimate oversight for clinical trial safety. But the person executing that vision would be a head of clinical compliance, who manages the day-to-day safety procedures and works right alongside the legal department.
So we've seen the rules, we've walked through some real-world examples, but let's zoom out one last time. Why does any of this actually matter? It all boils down to this one crucial point.
What these disclosures do is they drag accountability out of the shadows. They transform those vague, feel-good corporate promises into specific, personal responsibility. It changes the conversation from, we will do better, to this person on this committee is responsible for doing better, and here's how their performance will be judged. And what that means is that you now have a brand new accountability checklist. The next time you're reading a company's sustainability report, don't just get swept up in the promises. Look for actual names and job titles. Check for those specific committees, like an audit or sustainability committee. See if they mention how often those groups get progress reports. And most importantly, hunt for that link between performance and pay. That's really where the rubber meets the road. And that's really what I want to leave you with. Now that you know the rules of the game, you have a choice. The next time you see one of those big sustainability reports, are you going to look at the pretty promises? Are you going to look for the names of the people who are paid to keep them?